EPS is the number that could predict a stock's future. It's a technique that Wall Street insiders use daily. You can make smarter decisions in scenarios like when a company earning millions is a worse investment than one earning thousands. EPS, or earnings per share, is a crucial metric that reveals a company's true value. Think about a measure that demonstrates an enterprise's financial success. It's not just about how much a company earns, but how efficiently it's turning those earnings into value for you, the shareholder. In the next few minutes, you'll learn not just what EPS is, but how to use it like Warren Buffett, the world's most successful investor. By the end of this video, you'll have the tools to evaluate stocks with confidence. Let's start with the basics. To effectively analyze EPS trends, you must understand how to calculate earnings and how EPS is calculated. The basic formula for EPS is the company's profit divided by its outstanding shares. Imagine these three examples. Company C looks like the most profitable with 20 million in net income. However, when we calculate, we see that companies A and C have the same EPS of $1.80, while company B has a much higher EPS of $5. This example demonstrates how EPS provides a more accurate picture of profitability from a shareholder's perspective. Despite having double the net income, company C's larger number of outstanding shares and higher preferred dividends result in the same EPS as company A. Meanwhile, company B's smaller share count and lack of preferred dividends lead to a significantly higher EPS, potentially making it more attractive to investors despite lower overall net income. When analyzing EPS, it's important to distinguish between two types. The basic EPS uses the current number of outstanding shares, while diluted EPS accounts for all potential dilution from convertible securities and stock options, and is often considered a more conservative and accurate measure, as it provides a worst-case scenario of earnings power on a per-share basis. However, keep in mind that EPS has its limitations. Companies can manipulate it through share buybacks or accounting tricks. When a company repurchases its own shares, it reduces the number of outstanding shares, which can increase EPS even if actual earnings haven't grown. Another approach involves accounting maneuvers. A company might time the recognition of revenues or expenses strategically. When it comes to reality, rising EPS often leads to higher stock prices. This metric provides insight into a company's financial performance relative to shareholder investment. Yet interpreting it requires consideration of various factors. A high EPS in a struggling industry might be more impressive than an average one in a booming sector. For those prioritizing dividend payments, should pay close attention to EPS. It's a key indicator of a company's ability to maintain and grow its dividend payments. So, when evaluating investment opportunities, consider EPS as a key factor in your decision-making process. However, this video is just the beginning. For a more comprehensive understanding of EPS analysis, I encourage you to read our detailed post in the blog. The link is in the description. In there, there's an in-depth examination of EPS trends, discusses its limitations, and explains how to integrate EPS with other financial metrics for more informed investment strategies. If you found this video helpful, take a moment to like this and subscribe to our channel. Also, don't forget to hit the notification bell to stay updated on our latest videos.